Welcome to the Deep Dive. We're jumping straight into Abbott Laboratories' Q3 2025 results today, ABT.
Yep. And the big question you need answered is why the stock dipped after, well, pretty much meeting expectations. There's a story there.
Okay, let's get right to it. The headline numbers. Adjusted EPS.
Came in at $1.30. Bang on consensus. No surprise on the earnings front.
Right, so exactly as expected. But revenue, that's where the hiccup was.
Yeah, a slight one. $11.37 billion. The estimate was just a touch higher, $11.4 billion. So technically a miss, but really small, like negative 0.26%.
Okay, less than 0.3%. And the stock dropped, what, 3-4% on that?
It did, between 3% and 4.03% right after the announcement.
That seems disproportionate. Why is such a focus on that tiny revenue miss when they hit the profit target?
Well, it's about where the market's focus is right now. It seems to be on potential risks rather than just the bottom line number.
So what risk did that small miss signal?
It allowed investors to zoom in on specific weak spots. One analyst did suggest, that maybe it was just exchange rates, which usually gets a pass. But digging into the segments, you see the real drag was performance in China, specifically diagnostics. That little revenue miss just gave the market an excuse to worry about that structural issue.
Got it. But it's interesting because operationally they seem to be doing well. Didn't margins improve?
They did, yeah. Adjusted operating margin was up 40 basis points, climbed to 23.0% of sales, so they're definitely getting more efficient.
But that positive sign got lost in the noise about China.
Pretty much. The market narrative focused on the risk, but that efficiency does underpin their confidence, which you see in the guidance.
Okay, let's talk guidance then. What are they saying about the rest of 2025 given the market reaction? Did they lower expectations?
Nope, not at all. They held firm. They actually just narrowed the adjusted diluted EPS range slightly. Still targeting $5 to $12 to $5.18.
So keeping the midpoint the same.
Exactly, reaffirming it. Still points to double-digit growth for the full year. And they also stuck to their organic sales growth forecasts, 7.5% to 8.0%, excluding the COVID testing stuff.
Okay, solid confidence for 2025. What about looking further out? The CEO mentioned 2026.
He did, Robert Ford. He sounded very confident, said the company is very comfortable with the consensus estimates already out there for 2026.
And what does that consensus look like?
It's projecting continued high single-digit revenue growth, and importantly, keeping up that double-digit EPS growth.
That sounds pretty ambitious given the current headwinds. What makes them so comfortable with that?
They pointed to a few key things. Tailwinds, essentially.
Like what?
Well, first, just the ongoing momentum from their big products, Libre, TriClip, their electrophysiology devices. Second, new product launches coming through the pipeline, like Volt hitting the U.S. market.
Okay.
And third, they expect some of the major headwinds from this year, like the China pricing pressure and lapping the big COVID test decline, to ease up significantly by 2026.
Right, let's dive into those segments because that's clearly where the story split. There was a standout winner, right? Medical devices.
Oh, absolutely. MedTech was the star. Pulled in $5.45 billion in sales. That's 12.5% organic growth. Just blew past what analysts were expecting.
12.5%. Wow.
Yeah. If you just looked at Abbott as a medtech company, it was a fantastic quarter.
And that wasn't just one product line.
No, it was broad-based. Double digits across diabetes care, electrophysiology, rhythm management, heart failure, structural heart. Really strong performance.
Can we highlight a couple? Diabetes care must be Libre, right?
Definitely. Libre continues its run. Diabetes care sales hit $2.0 billion. That's up 17.2% organically. Huge.
Incredible growth.
And cardiac rhythm management, CRM, was also singled out, grew 13%, driven by their Avera leadless pacemaker. Management seems really excited about that one changing the standard of care.
Okay, so if medtech is booming at 12.5%, diagnostics must be where the trouble lies. What happened there?
Yeah. Diagnostics was the main challenge area. Overall sales were down, but that's mostly the expected drop in COVID testing revenue. It went from like $265 million last year down to just $69 million this quarter.
Right, the pandemic effect fading out.
Exactly. But the concerning part for the market was the base business. If you strip out COVID testing, organic growth was basically flat, just 0.4%.
Near zero. And that points back to China.
Directly. The big headwind there is something called volume-based procurement, or VBP.
VBP. Can you break that down simply for us?
Sure. Essentially, it's a government program where they demand pretty steep price cuts on things like diagnostic tests or medical devices. In return, companies get guaranteed volume in the market.
So lower prices for guaranteed sales.
Kind of, but it puts significant pressure on both your price and your volume expectations. It's really impacting their core lab diagnostics business in China right now, a major structural headwind.
Which explains the market nervousness, as it's not just a temporary blip, but you mentioned this is specific to China.
It is, and that's key. Outside of China, diagnostics actually look pretty solid. Core lab grew 7% ex-China, point of care testing grew 8%.
So the demand is there elsewhere.
The underlying demand seems fine, yeah. The issue is very much linked to those specific VBP dynamics in China.
Got it. Okay, quickly then, the other two segments, nutrition and established pharmaceuticals.
Nutrition saw about 4.0% organic growth overall. Pretty steady. Adult nutrition was strong, Ensure and Glucerna driving 5.4% growth.
Okay.
But that was offset a bit by U.S. pediatric nutrition, which was down 8.4% organically, partly giving back share they gained when a competitor had supply issues, and also losing a WIC contract. So a bit mixed there.
And EPD, the established drugs.
Solid. 7.1% organic growth. That segment relies heavily on key emerging markets. Think Asia, Latin America, the Middle East, and those markets were up over 11% organically. Shows good demand for their branded generics internationally.
All right, let's loop back to the future confidence. Management emphasized the R&D pipeline, said it generated nearly $500 million from new products this quarter alone. That must be fueling the 2026 optimism.
It's absolutely crucial. And you need to look at what these new products do. Take structural heart school. They just got TriClip approved in Japan.
TriClip.
Yeah, it's a minimally invasive clip treatment for leaky tricuspid valves, opens up treatment for more patients, and they expanded the European approval for their Navitor TVI heart valve system to lower risk patients too. Again, bigger market access.
Makes sense. And in electrophysiology, you mentioned the Volt PFA catheter earlier as a big deal for next year. What's special about it?
So Volt PFA launched successfully in Europe. U.S. launch is expected next year. The innovation isn't just the ablation itself. It's how it integrates with their mapping system, Insight.
Okay.
It allows doctors to perform the procedure with conscious sedation, not necessarily general anesthesia. That's a big operational plus for hospitals, potentially faster procedures, lower costs. That integration is key.
Interesting. Okay, that brings us to something potentially huge, maybe not even fully baked into the forecasts yet. That CGM coverage expansion.
Yes, this is the potential upside surprise. Management talked about ongoing discussions with CMS, that's Medicare and Medicaid in the U.S., about potentially covering continuous glucose monitors, CGMs like Libre, for type 2 diabetics who aren't using insulin.
That would be a massive new group of users, right?
Enormous, a huge patient population that currently doesn't have routine coverage for these devices.
And is that potential factored into their current 2026 guidance?
The CEO was very clear on this. No, they see positive signs, think it could happen next year, maybe, but it is absolutely not built into their current 2026 forecasts.
So if that coverage comes through,
it would be pure upside to their already strong growth projections, a really significant potential catalyst.
definitely something to watch.
Mm-hmm.
And finally, just to round it out, they have that long history of shareholder returns, too.
Right, the dividend. They just declared their 407th consecutive quarterly dividend, and they're a dividend aristocrat, 53 straight years of increasing the payout. That provides a certain baseline stability, even when the market gets choppy, like this quarter.
Okay, so let's summarize this deep dive for you. It was really a tale of two companies within Abbott this quarter. You had the MedTech division firing on all cylinders, driving double-digit growth with products like Libre and TriClip.
Yeah, really strong performance there.
But that was overshadowed, at least in the market's view, by the challenges in diagnostics, especially the flat underlying growth linked to those VBP pricing policies in China.
Exactly. The specific headwind pulled focus.
Still, management seems confident. They reaffirmed their full-year profit guidance, banking on that R&D pipeline and expecting headwinds to ease, projecting continued double-digit EPS growth into 2026.
Right. But the really interesting thing for you to track going forward isn't just the China situation resolving. It's that potential CMS coverage expansion for CGMs.
The type 2 non-insulin users.
Precisely. That market opportunity is massive. It's not priced in yet. And if that regulatory approval happens next year, like management hinted is possible, well, that could completely rewrite the growth story for Abbott.
A potential game changer hiding in plain sight. Definitely something to keep your eyes on. Thanks for joining us for this deep dive.